Hello and welcome to this edition of Hardman Talks. My name's Stephen Samuel from Hardman & Co. and I'm joined today by our CEO, Keith Hiscock. Keith recently authored a report called Investment Company Liquidity, Steady as She Goes, and today we'll dive into this piece. Can we start first by defining liquidity?
Yes, Stephen. So the Oxford English Dictionary defines liquidity as the availability of liquid assets to a market or company, and liquid assets are a high volume of activity in the market. So in short, liquidity is the lifeblood of markets, and measuring it over time is a way of gauging a market's health. Now, a market without liquidity isn't really a market at all, is it? Particularly following the events at Woodford Equity Income Fund back in 2019, professional investors are increasingly focused on liquidity when they make an investment decision. And if the liquidity in a stock or an investment company isn't good enough, they can't buy and they won't buy the shares.
Thanks, Keith. That's really interesting. So, how would you go about measuring liquidity?
Well, there are several ways of measuring it, and the most common ones are, first of all, the number of days traded. So even if only one share trades on a day when it could trade, that counts as a traded day. And what you do is you take the number of days when that occurred, divided into the total number of trading days in a year. It's a pretty crude measure, obviously. The second way is to look at the pounds million traded. So that's useful if you're running a big fund and you want to get £50 million into a position. You want to see how long it's going to take you, or indeed how long it's going to take you to get out of it. But the measure we use in our work is the percentage of shares in issue that are traded in a year. We think that's the fairest way of measuring liquidity. We use a variant of that whereby we compare the value of shares traded with the year-end market cap. Now, you need to be careful about that, because if, for example, it says that 50% of the shares traded in a year, that doesn't mean that half the shares in issue traded. What might have happened, for example, is that 5% of the shares traded 10 times in a year.
Thank you. And in terms of liquidity for trading companies, you wrote a piece last year. Can you tell us more about how investment companies actually compare?
Well, in our note on trading companies, we went back to 2016 and showed that liquidity had fallen really quite markedly. So back in 2016, on our measure, it was 60.6, that's 60.6%, and it had fallen to less than 45% by 2022. This note on investment companies tells a different story. It tells a story broadly of liquidity not changing, but the fact is it's lower than we measured in trading companies. So on our measure, investment company liquidity was 38% back in 2016. Remember, that compared to the 60% I talked about in trading companies. But it was only marginally less in 2023. It fallen from 38 to 35%. And then our report goes in and explores the details, looking not just at the whole market, but comparing what you'd call the alternative sector with the traditional sector. We look at individual sectors as the AIC analyze them, and then we look at market cap baskets. I think if there was one message to come out of this, apart from what I've already said about steady liquidity, it is that smaller investment companies have seen quite a sharp fall. Now, smaller investment companies are already under a lot of pressure from investors to do something. We've seen quite a few mergers, for example, to get scale. This report's going to add pressure to that, because it shows that liquidity is under strain at the smallest end. So if you take investment companies with a market cap of less than £25 million, it's halved. Back in 2016, it was 37.2%. The way we measure it, it was only 18.8% last year.
That's really interesting to hear. What are the effects of low liquidity?
Well, I think there are really three main effects for investment companies. The first is the lower the liquidity, the less interest there is from investors, because it's more difficult to deal in them, particularly for institutional investors. That can mean wider discounts, but it also makes it more difficult to raise new money.
Finally, what do you think investment companies can do to actually boost liquidity?
Well, we write quite a lot about a number of things that companies can do, but I'll just pull out two. The first is better communication, and that means better use of websites, maybe having a capital markets day, that sort of thing. And the second thing is more research. And particularly sponsored research. I'm sure you'd expect me to say that, given that I run Hardman & Co., the longest established sponsored research house. But actually, investment companies have been quite good in the sponsored research market. I think they've recognised that it brings more forecasts and it brings access to a wider audience, particularly a retail audience that generally the brokers don't have access to. And so if you look at the data, about 40% of alternatives already use a sponsored research house and 75% of traditional. So they're doing the right thing. But I think more of that, I think, is part of the steps to improving liquidity.
Well, Keith, thanks for your time.
Thank you, Stephen.
This was a very brief summary of the note. There's a lot of detail and further information in the note, which runs to 16 pages. You can access it for free on our website. And as always, thanks for watching. Please don't forget to like this video and join in the conversation wherever you're watching it. See you next time.